If someone has asked you to co-sign a loan for them, it means something specific. The lender doesn't believe that they can repay it on their own. That's not a judgment. It happens for all kinds of reasons. Maybe they're early in their career and haven't built enough credit history. Maybe they went through a financial setback. Maybe their income is hard to verify. Whatever the reason, the lender wants a backup and they've chosen you. Before you say yes, there are things you need to understand about what co-signing actually means, how it affects your financial life, and what your options are if things go wrong. This video is about making sure you have that full picture before you sign anything. A cosigner is a person who agrees to be legally responsible for someone else's debt. When you cosign a loan, you are telling the lender, if this person doesn't pay, I will. And the lender takes you at your word because that commitment is legally binding. The debt shows up on your credit report, the payment history affects your credit score, and if the primary borrower stops making payments, the lender can come after you directly without exhausting their options against the primary borrower first in many cases. One thing cosigning does not give you any ownership of what the loan is actually paying for. So if you co-sign a mortgage, you're not on title, you have no legal right to live in the home or make decisions about it. Your only role in the transaction is financial. You're on the hook for the debt and that's it. The FTC requires lenders to give cosigners a document called the Notice of Cosigner before any agreement is finalized. The language in that notice is direct and worth reading carefully. It says you are being asked to guarantee this debt. If the borrower does not pay the debt, you will have to. The creditor can collect this debt from you without first trying to collect from the borrower, and if this debt is ever in default, that fact may become part of your credit record. That's the agreement, so make sure you understand it before you sign. One more term worth knowing before we go any further: a cosigner is different from a guarantor. So back a loan, but typically has put up collateral like cash, property, or other assets as security. A cosigner doesn't put up the collateral, but both share legal responsibility for the debt if the primary borrower defaults. So if someone uses the word guarantor in your transaction, make sure you understand exactly what's being asked of you. There are legitimate reasons someone might need a cosigner that have nothing to do with their character or their ability to manage money. They might be young and simply haven't had time to build a credit history. They might be self-employed with income that's hard for lenders to document. They might have come through a difficult period, maybe a medical event, a divorce, a job loss, and are just rebuilding. So understanding why they need a cosigner helps you assess the actual risk that you're taking on. Ask them directly. Ask what the lender's specific concern is. Ask how they plan to make the payments, what their monthly budget looks like, what their backup plan is if their income changes. If they have a clear, honest answer and a realistic plan, that's a meaningful signal. If they're vague or defensive, that's also meaningful. The lender determines this person isn't a sufficient credit risk on their own. Your job before co-signing is to reach your own conclusion about whether you agree with that assessment or whether you're comfortable accepting the risk regardless. When you agree to cosign, you're also going through a portion of the loan application process yourself. The lender will review your finances alongside the primary borrowers. Here's what they're typically looking at: your credit score, so you'll generally need to meet the minimum credit score requirements for the loan program and for that specific lender. Your income, so lenders need to see that you have enough stable income to cover your own existing debts, plus the new loan payment if it ever becomes necessary for you to step in. Your debt to income ratio, so how much of your monthly income is already committed to existing obligations. Your documents, so a government issued ID, social security card, tax returns, and bank statements commonly required. So some lenders have additional requirements as well. For example, certain lenders require the cosigner be a close friend or family member of the primary borrower, maybe like a parent, a sibling, or a similar relationship like that. And lenders typically prohibit cosigners who have a financial interest in the sale, such as the seller themselves or a real estate agent involved in the transaction. Before you agree to cosign, understand what the application process will look like for you and what documentation you'll need to provide. Your credit is likely part of why you were asked to cosign in the first place, and cosigning will affect it in several ways, starting immediately. The first effect is a hard inquiry. When you apply alongside the primary borrower, the lender pulls your credit. A hard inquiry causes a small temporary dip in your credit score. On its own, it's not significant, but it's the first of several ways the loan touches your credit profile. The second effect is the new debt showing up on your credit report. Even though you're not making the payments, the full loan balance appears as an outstanding obligation on credit. This increases your overall debt load in the eyes of future lenders. The third and most ongoing effect is that the entire payment history of this loan becomes part of your credit history. Every on-time payment helps your score. Every late payment hurts it. A default is treated as your default. A foreclosure on a co-signed mortgage can appear on your credit report the same way it would be if you had taken out the mortgage yourself. You have no control over any of this because you're not the one making the payments, but the consequences land on your credit either way. The fourth effect is when many co-signers' loan stays on your credit report for the life of the loan, potentially 30 years on a mortgage. That's not a temporary commitment. It's a long-term connection between your financial health and someone else's payment behavior. When you cosign a loan, that debt counts against your debt-to-income ratio, also referred as DTI, even if you're not making a single payment on it. Your DTI is the percentage of your gross monthly income that goes towards debt obligation, and lenders use it to determine whether you can take on additional debt. Here's what that means in practice. Say you cosign a mortgage for a family member, and the payments are $2,000 a month. You never touch that payment. They cover it every month without issue. But when you go to apply for it on your own mortgage, your own car line, or your own line of credit, that $2,000 is already counted against your debt-to-income ratio as if you were paying it yourself. So depending on your income and your existing obligations, this could make the difference between qualifying for the financing you want and less than you need. So if you have any plans in the near term to buy a home, refinance, take out a business loan, or access any significant credit, co-signing someone else's loan first is a decision that deserves careful thought. The timing matters as much as the decision itself. One of the most important things to understand about cosigning is how you get out of it, because it's harder than most people expect. You cannot simply ask to be removed. Your name stays on the loan until one of two things happen. Either the primary borrower paid off the loan in full, or they refinance the loan in their name alone, which requires them to be able to qualify on their own. That's the same qualification that they couldn't meet when they needed you in the first signer release option in the loan, but they're under no obligation to do so, and they have very little incentive to offer it. You reduces their security. It's called a release of liability. That means if the relationship changes, if you have a falling out, if they stop communicating with you, if they fall behind on payments, you don't have a clean exit. You're connected to this loan for as long as it exists. And typically that release of liability option, it's only valid for divorcing couples. So think about where you'll be in 5 years or 10 years. And then if this is a 30-year mortgage, think about where you'll be in 30 years. Is this a commitment you're prepared to carry that long? If the primary borrower misses payments, the lender will contact you. They can pursue you with the same collection methods, including lawsuits and wage garnishment. The fact that you didn't make the purchase and don't live in the home doesn't change your legal obligation. If you co-signed a mortgage and the borrower defaults, the foreclosure can appear on your credit report. In some states, lenders can pursue the co-signer for any remaining balance after a foreclosure sale if the property doesn't sell for enough to cover the loan. And if you've offered any personal property as additional security on the loan, like a car, investment, or other assets, that property is also at risk. None of this is theoretical. These are the scenarios the lender is preparing for when they ask for cosigner. So make sure you're prepared for them too. Money and relationships are complicated, and cosigning puts both on the line at the same time. If the primary borrower falls behind and you're forced to make payments on a loan for a home that you don't own, or your credit takes a hit because of their late payments, the financial stress can create real strain. People who cosign with the best intentions have ended up in disputes, estrangements, and legal situations that they never anticipated. It doesn't mean cosigning is always the wrong choice. It just means going in with the clear expectations will give you a better chance getting through it with both your finances and the borrower defaults and your relationships intact. So before you agree, have an honest conversation about what happens if something changes. What's the plan if they lose their job? What if they decide to sell the home? What if they want to refinance but can't qualify? So setting those expectations up front and ideally putting some of them in writing is the kind of groundwork that protects both of you. If you decide to move forward, there are steps you can take to stay informed and protect yourself through the life of the loan. Ask the lender to send you a monthly statement. So if you're receiving the same statements as the primary borrower, you'll know immediately if a payment is missed rather than finding out when it shows up on your credit report. Ask the lender to notify you directly if a payment is missed or if the terms of the loan change. Not all lenders will agree to this. Getting ahead of a missed payments before it escalates gives you options you wouldn't have otherwise. Request online access to the account so you can monitor repayment status yourself. This is something you can arrange directly with the primary borrower, and check your own credit reports regularly. Monitoring them lets you spot any impact from the cosign loan quickly rather than after the damage is done. Keep copies of all loan documents, so the loan agreement, the truth in lending disclosure, and any correspondence with the lender. If there's ever a dispute, having those records matter. It's worth knowing that cosigning isn't the only way you can help somebody in a similar situation. If the primary borrower's main obstacle is the down payment, a financial gift towards the down payment can help them qualify, reduce their loan amount, and potentially eliminate the need for mortgage insurance without putting your credit and borrowing power on the line. Many mortgage programs allow financial gifts from family members, so if you want to be more involved in the purchase and are willing to share ownership, becoming a co-borrower is different from co-signing in one important way. Co-borrowers are on the title, so you would have legal ownership of the property, which is a meaningful distinction if you're going to be financially responsible for it. So if the primary borrower's issue is a high debt to income ratio, helping them pay down some of their existing debt might be enough to get them over the qualification threshold without you taking on the mortgage at all. Each of these alternatives comes with its own considerations, but if you're uncomfortable with the exposure co-signing creates, it's worth exploring one of these paths to get the same result with less risk to you. Co-signing a loan for someone is a meaningful act of support, and it's a significant financial commitment. Both things can be true at the same time. Going in with a clear understanding of what you're agreeing to, how it affects your financial life, and what your options are if circumstances change is the difference between a decision you made carefully and one you made out of obligation. So if you're navigating a situation where co-signing is on the table, whether you're the person being asked or you're the borrower trying to understand what you're asking of someone, use the link below to book a call with my team. These conversations are worth having before anything is signed. Mortgage and lending decisions actually work. Make sure to hit that subscribe button. My goal is to help you make informed decisions with confidence and ultimately win with Wade. We'll see you in the next one.